All right, a brand new bill just passed, and it's massive.
The motion is adopted.
870 pages of tax changes, retirement tweaks, and a few things the media isn't really talking about. If you're already retired or just a few years away, this will impact you in a big way. And don't worry, I'm not going to waste your time reading 870 pages on camera. That would take forever and be incredibly boring. Instead, I'm going to break down exactly what I think matters most, the tax changes that affect your retirement. And as a bonus, we just created a handy ebook summarizing these important points. You can grab it for free right on my website at celestialwm.com/BBB ebook. I'll provide a link to it in the description down below. All right, let's get into this. Most people don't realize how big a deal tax planning is when you're retired. And this new bill just changed the playing field, especially for everyone over 65. We've got permanent changes to tax rates, standard deductions, some temporary changes that you'll want to act on fast, and even a brand new senior bonus deduction that could lower your tax bill by thousands. The government may still be taxing your Social Security, but there are some new ways to lower that burden. So stick around, because I'm not just going to explain what changed, I'm also going to show you how to use those changes to your advantage. Let's start with the good news. The tax brackets that we've had since 2017, those ones from the Tax Cuts and Jobs Act, they were originally set to expire at the end of 2025. And that's what I thought would happen even as little as a year ago. That would have meant tax increases for just about everyone. But this new bill makes those rates permanent, or at least as permanent as anything in the government can be. That means the 10%, 12%, 22%, 24%, and so on, those marginal brackets, they stay the same. If you've been doing Roth conversions or retirement withdrawals based on these rates, you now have more clarity moving forward. Those key spots, what I call the sweet spot in the tax code, they're still there. That's the big 12% bracket before it jumps substantially to 22%, and the big 24% bracket before it jumps to 32%. Those are brackets that you want to maximize with solid planning starting today. Actually, starting yesterday. Now let's talk about the standard deduction, which is the chunk of your income that's not taxed at all. For 2024, joint filers got a $29,200 standard deduction. That was supposed to rise to $30,000 in 2025. But thanks to this bill, it's now going up to $31,500. And single filers go from $14,600 to $15,750. And here's the kicker. Those numbers are also now permanent, meaning they're not set to expire. A Congress has to have enough votes in the future to raise them. If you're 65 or older, you also get an additional deduction, $1,600 per person or $3,200 for a couple. So a married couple over 65 now has a standard deduction of $34,700. And that's before we even get to the bonus deduction. That means you can make $34,700 of income as a married couple, 65 or older, and pay zero in taxes. That's a great start for retirement income planning. So originally, this bill was going to be a game changer for people using health savings accounts, typically called HSAs. And you know how much I like those. It had provisions to double HSA contribution limits and allow Medicare Part A enrollees to keep contributing if they wanted. That would have been huge, but those changes didn't make it into the final bill. They were all scrapped late in the process. There's a few minor HSA rule tweaks that made it in, but nothing close to what was originally proposed. So if you've heard rumors about HSA changes, you can ignore them for now. Well, we all heard on the campaign trail President Trump talking a lot about ending the taxation of Social Security benefits.
No tax on Social Security.
Well, this bill, it didn't do that. The same old rules still apply. Depending on your income, up to 85% of your Social Security can be taxed. And the income thresholds that determine this, they haven't changed in over 40 years. They're not inflation adjusted, which means that more people get taxed every year. That's why they were promoting a big change there. But the bill did introduce something new, the senior bonus deduction. You've probably already heard a lot about this. Every news channel, blogger, AARP, and YouTuber has talked about it. If you're 65 or older, you now get an extra $6,000 deduction per person on top of your standard deduction. And you can use it whether you itemize or take the standard deduction. So that's $12,000 of additional income that is not taxed for a married couple 65 and over. This is temporary through 2028, so work with your financial and tax advisors to take advantage of it before it's gone. This bonus deduction helps offset some of the taxes on Social Security income, but it doesn't eliminate them. There's a big asterisk here though. They didn't want this deduction to be available to people who make a lot of income. This deduction begins to phase out at $150K for couples and $75K of income for singles, and disappears entirely at $250K of income for couples and $175K for singles. These income limits are controversial. While I can understand the administration not wanting to give the deduction to people making millions of dollars of income in retirement, a hardworking couple, each making modest incomes in their late 60s or early 70s, will most likely be phased out, and that's not good. Here's something new starting in 2026. If you take the standard deduction and make charitable donations, you'll now be able to deduct up to $2,000 as a couple or $1,000 as a single filer. And this is permanent. It's a big deal for people who don't itemize, because up until now, you couldn't deduct those gifts unless you itemize. It's a big win for 90% of Americans who use the standard deduction. Now, if you do itemize deductions, there are a few changes that you'll want to know. First, the SALT deduction. That's state and local taxes. It was previously capped at $10,000. It's now raised up to a $40,000 deduction if you itemize and your income is under $500,000. Over that, it gradually phases back down to $10,000. And this is a temporary change and only lasts through 2029. Mortgage interest deductions, including mortgage insurance premiums, are now permanent. No change there, just more clarity as they were previously set to expire. And here's a curveball. Up to $10,000 of car loan interest is now deductible, but only for brand new US assembled personal use cars, not business vehicles, and it phases out at higher incomes, $100K of income for singles and $200K for couples. It applies if you bought a car and took out a loan in 2025 or later, so it's immediate. But this break does expire in 2028. And due to income limits of this deduction, it appears that the benefits would go to those mostly in the 12% or 22% tax brackets. It could be worth up to $2,200 in tax savings for some couples. All right, here's one for business owners. Business owners with pass-through entities, including partnerships and S-corps. It retains the PTE exception, and business owners can still deduct their state and local taxes at the entity level. The deduction flows through to the owners through their K-1s. Personally, as an advisor to many business owners, I'm happy this was kept in the bill. It results in a large tax savings for the largest segment of job creators in our country. So as a business owner, if you're making over $500,000 and you thought you were going to be phased out on the SALT deduction, as long as your tax advisor allows you to use this rule through deducting the state taxes through the business, you should be good to go. Another thing to make sure of is not every state has allowed this workaround. So make sure you work with your tax advisor to confirm that your state allows it. All right, what about estate taxes? Well, the estate tax exemption was supposed to be cut in half after 2025, back to the pre-2018 levels. And that was going to be huge for high net worth family planning. Many more families would have needed to explore advanced strategies to shield their wealth. But the bill increased the exemption slightly to $15 million per person or $30 million per couple and made that permanent. This affects a small sliver of American families, but the clarity now that it is permanent can really help planning for those families. Okay, so what does all of this mean for you? Well, first of all, no matter who you are, it likely means you will pay less tax than if we reverted to the 2016 tax laws of lower standard deductions and higher marginal income tax brackets. That's a win. If you're nearing retirement or already retired, here are 3 smart strategies to consider while this new landscape is in place. First, make sure you reevaluate your Roth conversion strategy. With tax brackets staying the same and added deductions in play, you may have more wiggle room to convert more IRA dollars at lower tax rates. It won't be right for everyone, but make sure your planners and planning software are integrating the new deductions as you make your decisions. Second, rethink how you're managing your required minimum distributions. The senior bonus deduction and the expanded standard deduction could make room for more efficient IRA withdrawals now, helping you lower future RMDs or avoid bumping into the IRMA Medicare surcharges. It may make sense to take larger than needed distributions if you can get those funds out of the IRA in these lower tax brackets. If you're going to need the funds in the next few years and delaying might push you into higher brackets, it may make sense to apply some advanced withdrawal planning right now. And third, consider harvesting capital gains in your brokerage accounts. Let me say that again. Consider harvesting gains. Usually, planners discuss harvesting losses to offset gains, but with these expanded deductions, you may be able to reset your cost basis and take gains at little or no tax. Remember, if you're single and your taxable income is below $48,350, or if you're married with taxable income below $96,700 in 2025, you pay 0 on any capital gains generated. Of course, this all depends on your personal situation, but this bill created a very unique 4 to 5 year window where smart moves can add up to big savings. And that was just one slice of this giant bill, but it's probably the part that matters to you most. If you found this video helpful, maybe share it with someone you know, and make sure you grab a copy of the ebook version of this video so you can refer to it throughout the next few years. There's a link to it down in the description, or you can head over to my website at celestialwn.com/BBB ebook. And check out this video next for even more ways to supercharge your net worth.